Your basic thesis for U.S. equities in 2015 is valuations are not stretched. But by the same token, you're not as bullish on GDP in the United States as perhaps the rest of the street. Explain the contradiction there.
Well, I think, if you look at valuations, Scarlett, and let's look at something simple like a price-to-earnings ratio. The median over the last 35 years or so is about 16.7 times. We're right about there right now. We have a $128 estimate for the S&P 500 next year. You do the math on that, and we're a little shy of 16.7, actually. So I think stocks can do well in a modest growth, modest inflation environment. We're looking for 2.8% GDP next year. So really, when you have that kind of steady and slow pace, that can win the race, and that's certainly been what happened the last few years. And I think, really, to be honest with you, I think beyond 2015, we probably have 2 or 3 more years of this to go.
Scott Wren, last time I checked 35 years ago, there was nothing called a mobile phone that many people could purchase. So let's just put aside history for a moment and look forward. What about the technology sector? Do you think that deserves a higher PE than historical norm?
Pim, I do not think so. I mean, I think, clearly technology has been unbelievable over that period of time. Certainly in the time that I've been in the working world, from the floor of the Chicago Mercantile Exchange, where everything was done by hand, and now the floor is pretty deserted. But I think technology is one of the favored sectors that we like. I think that versus history, you're probably going to be in line on a PE type of basis. But I would think that we're going to see better capital spending by businesses on technology. A lot of them have not really kept pace with where they should be. So for us, one of the reasons why we like technology is not necessarily all the new things coming out, but just the fact that these businesses need to spend on technology to catch up really with where they should have been here over the last few years.
Scott, you said you're looking for $128 in S&P 500 operating earnings. You've also published your year-end forecast for 2015, looking for the S&P to reach at least 2150, potentially to as high as 2250. That's against the consensus of 2225. And if you look at how it compares to some other strategists on the street, you're certainly on the lower end. What risks is everyone else underestimating? What are they overlooking?
I think, Scarlett, really the many people on the street are expecting a real acceleration in economic growth, and you see a lot of 3+% GDP estimates out there. So in my book, one of the things that people are getting a little too hyped, investors as well as analysts, they're getting a little too hyped up on what we've seen these last couple of quarters in terms of economic growth. And while they may not be expecting a 5% next year, they're expecting a consistent acceleration in the economy here in the States. I think we're going to be better than we have been this year, a little bit better, but not a lot better. So we're expecting good things. And once again, that slow and steady can win the race. Low inflation and modest growth, I mean, that is perfect. And we could be in that environment not only through, as I said, not only through next year, but I think probably for the next couple of years at least.
Scott, that slow and steady seems to be the real key here. I mean, we've got that amazing 5% number in the third quarter for GDP growth. Predictions of much slower, although great growth in the fourth quarter. Does that kind of volatility in the growth, will we see that in corporate results as well?
Corey, I don't really think so. I don't think the street really believes, many on the street don't believe that we're going to see the kind of volatility in corporate earnings that we've seen in GDP here. I think certain sectors, and energy is a perfect example. Energy sector earnings are going to be down a lot in the fourth quarter. We don't want our clients focusing much on that. We want them to think a little bit ahead and say, hey, what are the benefits to the economy, to transportation, manufacturing? These lower oil prices are going to bring. So I think net, in the short term, earnings are going to get hit in the energy sector, and therefore for the S&P a little bit in the fourth quarter. But then we're going to see some better benefits in 2015. And I think that corporate earnings, other than a couple of sectors, energy being one, they are the staples. Healthcare, they're going to be pretty steady. I don't think we're going to see a lot of surprises one way or the other from overall corporate earnings. But, you know, you'll see things like the energy sector have a couple of bad quarters here.
Scott, Wren, net, the S&P 500 is up about 12.5%. Did you call that this year?
I tell you, Pim, when we came into the year, we were not bullish enough. I will say, though, that we had a midpoint of 2,000 for the S&P 500. We made an adjustment. You know, you've been around long enough to know you got to have a little luck in this game. After the close on October 14th, we bumped that up to 2075, so we moved it up by 4%. And, you know, by some miracle, some skill, and a little bit of luck, we're close to it right now. So we were not bullish enough coming into the year, though. I don't think we're going to see this kind of year next year. I'd love to be wrong about that because I think we're leaning the right way. But I think you're going to see more modest growth, 6 to 10% advance next year. You know, probably 6 to 10% advance in 2016 as well.
Scott, I've been tweeting out all day the best and worst performers of companies that still have some kind of market cap. The stocks that went to zero, I didn't put in my list. And I was surprised as I went through the list and updated. I looked about a month ago. First of all, a lot of different names. But oil and gas small caps, you know, companies under 5 billion market cap, obviously really took it on the chin. And I wonder if that's a place where there is some opportunity already, where there are some real assets there, even as lifting costs have risen.
Well, I think what you have to do in the energy sector and some of the work that we're doing, our forward-looking work, things like, you know, drillers, things like exploration and production, things like equipment and services, those are starting to show a little bit better. But I still think, in a way, it's almost like a catch-the-knife kind of play right now. So I think if you buy anything in the energy sector, I think the big integrated oil companies, that's where you want to be. They're hedged against this price to a large extent. And if you want to take some high flyers, I would stick with the larger caps. You might go into those industry groups that are a little more sensitive to the price of oil, like the ones I mentioned. But you need to come into this thing saying, I'm gonna hold these. I know the price may go against me here initially, but you know, a year from now, 2 years from now, I might be making money on these things. You got to be patient with these in here and realize you're probably not buying them at exactly the bottom.
Okay, Scott, final question to you. I know that you're based in St. Louis, but you travel all around the country meeting with clients, customers. You were in New York not so long ago joining us on Surveillance. What is the question that your clients ask you the most, and what do you tell them as your answer?
Well, Scarlett, really, over the last few years, our clients have been, they have not believed, overall, our clients have not believed that the U.S. economy is going to really hold up. They've been expecting a recession. And so what we've tried to do, the question is, you know, is the economic recovery going to continue? And what we've tried to do, we make a lot of economic projections. We try to publish those. We try to talk about those. That's a tough job because we have a lot of non-believers in our retail client list. So, you know, for me, that's one of the biggest jobs is trying to say, hey, look, guys, the world is not coming to an end. We have a cyclical bull market that's likely to last a few more years.
Right.
It's worth investing in. You know, don't give up on stocks right now.